Hey, it's Eric Powell with the Future Mill. Let's talk about the elephant in the room. The stock market is being talked about every time you watch the news. YouTubers are steadily saying their thoughts, and your financial expert friends on social media are giving their opinion just 1 month after they were experts on whether Carol Baskin really did kill her husband. That being said, let's talk about the stock market and how to invest during this crisis. If you are watching on YouTube, be sure to tap the like button gently and subscribe for more financial education videos. Facebook and Instagram users, be sure to like and follow. The stock market has literally went from an all-time high to a drastic low and then a sharp rebound, all within about a 2.5-month period. We have seen a bear market and a bull market in these past 2 months. And to put it into perspective, think of having $100,000 in the S&P 500. If you were to look at your account at the high on February 20th, you would have $100,000. Then on March 23rd, your money would be down to $66,000, a 34% drop or $34,000 drop. Then on May 1st, your money would be $84,000, $16,000 down from the high, but $18,000 above March 23rd. To say we have been on a roller coaster ride is an understatement. Many experts are projecting another downturn due to economic data such as a 4.8% decrease in GDP, almost 10% unemployment rate, decrease in imports and exports, and the list goes on. With all the data, why then has the stock market continued to rise? Part of the answer is optimism. The curve is flattening. Local governments are slowly opening, and people are hopeful we can get back to life as we once knew it. But this is creating a sense of hope in the markets, and people feel they should jump in to buy low because the market may go up from here. Will people be right that the market is recovering, or will those with a glass half empty approach be right? Only time will tell, but the fact is we haven't seen the worst of the data from businesses because the economy was functioning normally for the first 2 months of the year. Businesses shut down or slowed in March, and it is being reported on the quarterly earnings from companies, but we have yet to see what the second quarter will bring. The second quarter earnings for companies should be much worse if they saw a negative impact on their first quarter. April, May, and June are all in the second quarter, and many businesses may not be fully operational by the end of the second quarter. The danger is we don't exactly know where the market goes from here. Stocks are driven by emotion and not directly linked to economic data. That is why you've seen the stock market rise in April, as we have also seen the highest number of unemployed individuals in American history. People are looking at the stock market and making moves based on what they think will happen. Some people are buying constantly because the market is still low compared to its all-time high, but some people are on the sidelines waiting to see if it drops again, and others are just riding the waves. So what do you do with your money? First, you should not be looking at the short term if you are investing. I know this is easier said than done, and you hear of people doubling their money on stocks, but you may not hear the other side of this, where people will lose it all by betting on stocks that go bankrupt. Second, quit trying to market time. Data shows us that just missing the best 5 days in the stock market could decrease your earnings by over 2%. Missing the best 60 days in the market would provide a negative return. Third, review your allocation. Not everyone can handle being 100% in the stock market, and if you are retired, maybe you shouldn't be there anyway. Remember the $100,000 I talked about at the beginning. If you had invested part of your money in the aggregate bond index, your money would not have grown as fast, but it also would not have gone down as much. Fourth, invest and stop looking. This is in line with the second tip of not market timing. If the market is down and you are investing for the long term, sure, you could wait until the market hits the bottom and then buy, but where is the bottom? So what are you waiting for? We don't know where it's going to be. A great strategy to keep yourself from trying to time the market is to invest a set amount of money in the market daily, weekly, or monthly throughout the year. This strategy is known as dollar cost averaging and allows you to participate in the market and not worry about market timing. Fifth, remove the emotion. Emotional investing is dangerous and can cost you everything. When I started investing at 21, I had no clue what I was doing, and I was emotionally investing based on what I felt versus a long-term diversified strategy. If you are investing for yourself, You must remove your emotions from your investing strategy and be sure to diversify your portfolio. If you are looking for an expert to help you implement these tips, go to thefuturemill.com, book a call, and we'll be happy to help you. If you've made it to the end, please be sure to like, subscribe, follow, all of that social media lingo. As always, thank you for watching.